Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. With the Fed's latest decision to hold rates, but also signaling rate cuts ahead in September, we sit down with institutional portfolio manager Ilan Kolet to get his insights into the current inflationary environment and what it means for the Global Asset Allocation team's fund positioning. Ilan speaks to host Pamela Ritchie about current U.S. unemployment numbers, productivity, and how the latest data is creating optimism in the markets. Ilan, who previously worked at the Bank of Canada, says the BOC is not motivated by geopolitics or other macro themes, but rather influenced by monetary policy and not politics. Ilan says the GAA team continues to be overweight U.S. equities, albeit slightly trimmed down. He adds they are also overweight commodities and are invested into EM as they see this area filled with potential growth. This podcast was recorded on August 1st, 2024.
Great to see you. Thank you for joining us.
Very nice to see you.
This is very exciting. Very exciting to have you here to talk about these things.
Indeed.
Did you watch it all? Listen to it all?
I watched it. I'm not going to joke. I watched it twice.
Yeah.
Right? So I watched it. I read it, and I watched it again this morning. This is the playoffs for me.
This is the playoffs for you. Absolutely. Okay. So they've held. One of the main messages did seem to be a bit more on the labor side, the dual mandate. I remember you attending a rather prestigious group, actually, that you're a part of. And a couple of years ago, they said probably the Fed will hold until the labor story starts to really rattle around. Is that happening?
There are signs of that. I mean, I think the messaging from Chair Powell, from the Fed, has been unbelievably consistent, right? It has been two words: data dependency. I mean, this is something that he highlighted yesterday, really skillfully. He talked about being data dependent, not being data point dependent.
That's massive.
That is massive. I mean, that's, I think, probably the most important line in the entire presser, in the entire press conference, was this, again, this reiteration and reliance on data dependency instead of data point dependency. And what that means in English is the Fed is not looking at a single data point to decide we're not going to cut, and yes, we're going to cut because of that one number. Right. What they're looking at
Which is tomorrow. I mean, for instance,
exactly
tomorrow.
Right, exactly. So they're not looking at a single jobs number or a single unemployment rate. They're looking at the trend in the data across many, many different measures for employment and the labor market, as well as inflation. Right. So when I worked in Boston and used to brief portfolio managers on U.S. inflation, I had a dashboard that had around 36 numbers on it.
Data points.
36 data points just for the U.S. inflation rate, right? And that's what Chair Powell has tried to communicate, is that the conditions are basically now in place with a core or a total inflation rate that's much lower than where it was, and a labor market. So check mark, exactly. Inflation running at 2.5%, core at 2.6%. It was 3 times that just 2 years ago. Yeah. So inflation is almost there, and the labor market was exceptionally tight and has loosened, which in this case is actually a positive development, right? So a 70 basis point increase in the unemployment rate, fewer job openings, and that is the sort of reinforcement or positive news they need to see to confirm that rates no longer need to be as restrictive as they've been for the last 18 months.
And yet it's not an emergency.
Exactly. Yeah.
And so we think, based on what you know today, a soft landing.
I mean, the softest of soft landings. I mean, So it's very unusual to have a slowing rate of inflation. Well, it's very unusual to have all 3 of these separately, and it's very, very unusual to have all of them together. So we've had inflation sort of calmly come back to where it's supposed to be. And we had thought for a long time, the 8% to 4% was going to be fairly rapid. 4% back down to 2% would be a little bumpier, and that's sort of what we got. We had a slow rise in the unemployment rate. That's very rare, and normally
it's gentle.
A gentle rise. Normally, when the unemployment rate starts to increase, I mean, it's a straight line up, and then you're in the situation of cutting because you have to, not because you want to. But I think most remarkably, we have really strong rates of growth in the U.S. and what we believe is a productivity expansion, right? So all 3 of those things together are very, very hard to achieve. And so this is the type of, this is the way I think the communication from the Fed is going to evolve over the next, say, year or so, just sort of confirming this soft landing thesis. Now they're going to be very cautious and very incremental, and they're going to keep all that cautious language in forever. But that's sort of the direction of rates, I think, starting in September.
This prestigious group that you're part of is very tied into central bankers globally. What's it called, and what do you do there?
Yeah, so for the last 22 years, I've been a member of the National Association for Business Economics.
Okay.
Sort of a
What do you do?
collection of nerds.
Yeah, okay.
I mean that in the nicest way.
Yeah, absolutely.
Yeah, and last year I was named to the board of this association. And so, we have several conferences every year, but it also is a great forum for dialogue with academics, industry economists, and government officials and Federal Reserve officials. And so it just keeps you in the loop, with your finger on the pulse of a lot of different areas. For me, it's become a critical input into my investment process, and there's sort of continuously takeaways that I come back and speak to the guys about and speak to the team about, about what I'm sort of inferring from these conversations.
And you'll actually see Jay Powell there.
Exactly. Yeah. I mean, so I think I've seen Chair Powell speak, Greenspan, Yellen, Bernanke. Wow. So I think those policymakers enjoy coming to NABE conferences because it's almost like an industry event for them, because they're speaking to people who understand some of the technical details of central banking.
And
so they're
love
very
inflation
valuable.
as much as you do. They just love
Yeah,
looking
they probably don't love high inflation,
No.
but they certainly love low and stable inflation. Yeah.
Exactly. Let's dive into this somewhat contentious thing sometimes about the timing of the cut. And there is a U.S. election, and we know that. September seems to be what is pointed to right now. Is it related to the election?
Right, and so this comes up in a lot of conversations. A lot of people believe that, they can't cut before an election because it will change the outcome of the election. They can't cut right afterwards because it'll look like influence. What I can say definitively, having spent 8.5 years working at the Bank of Canada, and my colleagues David Wolf and David Tulk both were in the room for those deliberations and worked at central banks. The number of times that an election came up in the discussions around an interest rate decision in all of our collective experience was zero, right? So it never ever comes up. It never would come up. Monetary policy is fully independent of an election cycle. And there are many examples. Wall Street Journal has a great article this morning discussing all of the different cases in the last 50 years in which rates have been either hiked or cut in and around an election, right? So This is something that for some reason we still cling to. And I don't mean to disagree so forcefully, but it is one of these things that I think we should just put to the side as really noise, right? Monetary policy is determined by the central bankers running those institutions.
When you stare at WIRP, which is the world interest rate, what does P stand for? Probability, thank you. Many acronyms. So ultimately, it looks like the markets are expecting 3 cuts this year, starting in September, and then about 4 next year. Now, WIRP's been really wrong over the course of the last 6 to 8 months, even longer. What do we make of that?
Yeah, so WIRP is a function on Bloomberg, for those that don't know, that just looks at market odds or market pricing for expected rate moves, right? And like you said, it can move around a lot. It can be quite volatile. The thing to remember with WIRP or WIRP is it's an aggregation of probabilities. So 3 cuts this year, 4 cuts next year might be a bunch of people expecting some sort of disastrous scenario in the U.S.
Well, that's what you sort of wonder,
right?
yeah.
And expecting a bunch of cuts, and then a bunch of people that are more balanced or expecting fewer cuts, and the average comes out as 3 this year, 4 next year. What I would say, and I don't mean to be glib here, this is going to be a bit of an unsatisfying answer.
But sort of the takeaway is
I don't know how many cuts there's going to be. Chair Powell doesn't know.
No.
The experts that we hear from all the time don't know. I mean, this is a data-dependent process, which means we think we know rates are too high right now. If neutral is, say, 2.5 or 3, and we're at 5, we're restrictive right now. There will be a rate cut probably starting in September, and then some successive cuts, and then there will be a pause to examine incoming data. This is going to be the case in Canada and the U.S.
Sure.
To examine that data and remain data dependent, right? So what has been the effect of, say, 50 or 75 or 100 basis points of cumulative cuts? You don't know that until you do those cuts, and then you wait and you observe the incoming data. And if inflation starts to look, like it's picking back up, or the labor market the unemployment rate is turning over and pushing lower, those would be unwelcome signs. And you would see a change in the language and a change in sort of the positioning around future rate cuts, and then a big change in work.
Right. Okay, so that's sort of where it all comes in. Let's go into the wages story, which goes into ultimately what he's talking about on the labor front. Wages are growing, but more slowly. And this is what they wanted to see. This is sort of a key piece of it.
It really is. And this is something Chair Powell highlighted yesterday. Right. So the employment cost index came out yesterday in the U.S. and it showed us, an increase in wage growth, but slower than what people were expecting. And he sort of discussed, I think he mentioned that was a welcome sign. Okay, so we need to unpack a few things here. This will get a little bit nerdy, unsurprisingly.
It's okay, we're ready for it.
Yeah. But it's an important one.
It's very interesting.
Okay, so why are central bankers so singularly focused on the rate of wage growth and the labor market? Is because it's probably the single most important determinant of service inflation. So again, when the unemployment rate is very, very low, the way that you incentivize people to cross the street and join your firm is you pay them more. I mean, you can do things like put ping pong tables in break rooms and donuts and stuff like that, but really people want higher wages. And so you pay people more. And that pushes wage growth up, right, to fill that labor market void. And when wages increase, that's an input cost for a firm, right? And the firm passes that on in the form of a higher price. So a great example is you're short-staffed in your restaurant, you have to hire more people, you pay the waitresses and the cooks more, and the waiters more. That shows up as a higher cost on the menu, right?
Sure.
And that's that sort of service cost of eating out, that price increases. And the reason we care about services is service prices are 3/4 of the underlying pie chart on core inflation. Right? So inflation measures the cost of living across a whole bunch of things: food, energy, the stuff we buy in the grocery store, the stuff we buy at the mall. But the largest chunk of the inflation basket, and I think this goes a little underappreciated, is the price of people, right? Which is the price of services.
I think that does go underappreciated.
I think it does.
Yeah,
I think
we
it
don't
does.
focus on that as much.
And so, in the line item we get 354 lines of data under the PCE report every month. The line for electrical services, guess what that is? It's the electrician. The line for automotive repair, guess what that is? It's the mechanic, right? And so the price of people doing services influences the service price, which shows up in our monthly reports on inflation.
Right.
And what happened in the pandemic is goods prices spiked a lot higher because we were all competing for fewer goods.
Will those go down?
Those are now inflating at roughly 0%.
Okay.
Right. So goods prices will go up and down a lot easier than service prices. Right. So stuff will go on sale. I wouldn't expect anything to become dramatically cheaper over time. I mean, we all know that food and automotive and car prices are much higher than they were 2 or 3 years ago. They're not getting much cheaper. They're just going to inflate at a slower rate. But service prices, they're the stubborn part of the inflation basket, which the Fed, the Bank of Canada was really waiting for, really the Fed. And those are now slowing, at a reasonable rate to get the Fed back to its target.
So we're seeing these signs. Some of them are, as you mentioned, kind of in this gentle slope upwards of unemployment. Ultimately, for those that are saying, well, maybe the Fed should have gone yesterday in July because we might get a couple of points coming out, and that might, cause you to rush in some level or be behind the curve. It sounded like there were some ways he argued back to that, but there is a risk on some level of not going now.
Sure, absolutely. I mean, there is that question: if you know you're going to go in September, why didn't you go in August?
Well,
right?
yeah.
That's kind of that question. And again, I think there was probably enough evidence for the Fed to justify the starting of rate normalization, at yesterday's meeting. But the Fed is made up of a committee of members, and it's not just one person's voice. And so there are different views, even nuances within those views. And they're looking at a wide swath of indicators. They're never going to move preemptively by a lot based on what they think may happen. They need that data dependency to show probably a little bit more progress on inflation. I mean, the one thing I would say they're waiting for is, a 1 more month-ish of collective inflation data to show them that we are getting that consistent slowing in service prices.
Right.
And that will lead to that. And they will highlight that in their September communication. In September, they will call out, we have seen consistent progress. After stalling out in Q1, we are seeing now consistent progress on inflation pushing lower towards target. Because Q1 was sort of a lost quarter,
right,
sort of moving sideways.
So let's talk a little bit about the influence on the US dollar, ultimately, where it goes from here, and sort of the dispersion of global central banks, some of which have moved, well, the Bank of England moved, and then we saw the BOJ actually raise rates. Mm-hmm. So we've got this dispersion of the interest rate story, ultimately. What's it doing for currencies? What does the dollar do once the cut actually comes? Does it react before the cut comes? How do we look at that?
Right, and so of all the indicators to predict, I think currency and oil prices are the two worst ones. I mean, almost no matter what I say, I'm going to be wrong.
Yeah, okay.
But
anyway, what's the dollar going to do?
Right. But in order to give you a more useful answer than that, I can tell you sort of how we think about the currency and the Canadian dollar in the context of our portfolios, and then the factors that we think affect the value of the Canadian versus US dollar. Right. So in our portfolios, we use the Canadian dollar as a shock absorber. Sure. We've talked about this in the past. So
it lets off steam. Yeah.
Yeah, it lets off steam. Right. So we're underweight the Canadian dollar. We have been for some time. Because in the period of, say, underperformance by Canada, which is what we're expecting, one of the valves that would get released early would be a depreciation of the Canadian dollar, right? So, and if we're underweight the Canadian dollar, our funds get hurt less. So 2022 is a great example of how we effectively used an underweight position of the Canadian dollar to really preserve basis points. But in terms of the factors that affect the value of the Canadian dollar, I really think there are three. The first one is sentiment, right? So if Canadian households are stretched, if we start to get headlines of people not being able to afford mortgage renewals, right, which is coming, which has already started really,
yep,
that weighs heavily on the value of the Canadian dollar. The second one, which we used to have, I think you can sort of cross off the list, is the value of oil, the oil price, right? The petrodollar. Used to be the case that oil prices up, Canadian dollar up. That one you can sort of cross off the list now because of the 50% decline in oil capex in the last 10 years in this country.
Because oil is up as we
Oil is up and has done nothing for the Canadian dollar.
No,
again, 2022 we had oil at $100 and we had the Canadian dollar go from 82 cents to 72 cents. But the third one, I think, related to your question, is the interest rate differential.
Yes.
Right? And so the Bank of Canada has embarked on normalization or rate cuts sooner than the Fed, meaning that gap is opening up. And at some point, that gap will lead, we believe, to a depreciation of the Canadian dollar. Right. The one thing I would add here, though, is for folks that are familiar with our positioning, we actually trimmed our Canadian dollar underweight a little bit. It was.
So let's get into positioning. I really want to hear about that.
Yeah, so our Canadian dollar underweight was quite big, and we've trimmed it because, well, we look at sentiment indicators very closely, and sentiment was exceptionally negative around the Canadian dollar and positioning around the Canadian dollar. And we don't necessarily want to be whipsawed by that type of sentiment. So we have trimmed we have trimmed the underweight. Still significantly underweight, but that's trimmed slightly.
And let's go through ultimately, I mean, US equities was an overweight for you over the course of, I think, before the end of the year, straight through to somewhat recently. That was kind of the biggest story of your allocation, I think, and you caught a lot of that amazing rally. Where else have you made some adjustments?
All right, so the most important thing to take away right now is in our 60-40 portfolio, so that's a global balanced portfolio that many folks on this call will be familiar with, we're overweight equities, right? So that's the first thing to note is that 60-40 can be a 75-25 or a 45-55, right? So plus or minus 15%. We're nowhere near that right now. Right now, that 60-40 is called a 65-35.
Okay.
So slightly tilted and overweight to equities. And the big difference is we still believe that the U.S. is in the midst of a productivity expansion. But given the unbelievable increase that we've observed right since the end of since October of last year when we
Yes.
initiated this position. And the U.S. is up 20% year to date, right? That's twice as much as Canada or EFI or EM. We've reduced that U.S. position, right? So it was a very effective run.
You caught it, but
exactly,
yeah.
and so we've trimmed that a little bit, but there are overweights now in other parts, important overweights in other parts of the portfolio. So we've increased our exposure to commodities, and this comes from a number of different places. It comes from
Is that an inflation hedge?
Part of it is an inflation hedge, right? So really, regardless of what the U.S. election outcome is, it's almost regardless of whether it's person A or person B. And I started using person A and person B in case they switch
Kind of
again.
easier.
Right?
Yeah, they might switch.
So, regardless of the outcome, it's likely inflationary with kind of a move towards deglobalization, higher tariffs, et cetera, or higher fiscal spending. The other reason is we speak really regularly to the underlying managers that we use in our strategy. That's a really important pillar in our 4-pillar research process, right? So many of the folks that you speak to have been interested in commodities. So I think about a conversation we had with Hugo Lavallee several months ago, right, where we sort of really dug into the commodity thesis, his commodity thesis. And that's an important input into our process as well, right? So that's an important stream of research that we're consuming, is that conversation and the research that he's reading, and that actually affected the commodities position as well. And then the last thing on positioning that I definitely should remember is we're still cautious on Canada, right? So we're underweight Canadian equities. Again, I always have to clarify, underweight Canadian equities doesn't mean we don't
own any.
Exactly. Right. So 21% of that fund are Canadian equities. We're trimming it by 5 or 6%, a little bit lower, to allocate more of the equity position to other areas, commodities, alternative investments.
Yes.
But that's just because we think Canada will lag other regions, right? We're not cheering for Canada to implode, and nor would we ever. We have a lot of great managers in that Canadian equity stack, right? Andrew Marchese, Hugo, et cetera, Mark. If they beat their benchmarks, as they absolutely have, and we own them in our funds, we win as well.
You win as well. Fantastic. Some questions rolling in from the audience here. So, Ilan, what do you think of the issuance of treasuries by U.S. Treasury Secretary Janet Yellen on the long end of the U.S. curve?
Yeah, I mean, that's an interesting one. So those sort of micro market developments, I would say one of the things that's important, I think, for us to do, as well as advisors or investors, is really to step back and think about what is the goal here, right? So what is the goal in issuing treasuries, right? Or in either fiscal policy or monetary policy? And the way I would think about that right now is, there has been a considerable amount of fiscal spending in the US, and that really has bolstered or underpinned, I think, what we're seeing from a productivity side in the US. I mean, it's remarkable. I know we don't have charts today, but we've shared this in the past.
Yeah, the productivity, absolutely.
The productivity jaws that have opened up is remarkable in the US. I mean, investment spending in the US has pushed a lot higher. Some of that has come from
large tech companies that have cash flows.
Exactly, and supportive fiscal spending, and an accommodative, historically accommodative monetary policy environment. Not necessarily now, but the way that we think about this in the context of our funds is we think about policy, not necessarily politics, right? So we pay attention to politics, but policy is what really changes positioning. So that's sort of how we think about that.
You've mentioned that no matter what, there could be some inflationary forces, and therefore some of the hedges against that. Is there anything else that everyone might need to know about the policy implications that could or couldn't happen later on? Yeah,
I mean, so one thing we'll never do is we would never say, I think person A is going to win, so we should buy these asset classes, right? Okay. That's just not our edge. To be quite honest, our edge is not choosing what the investable universe will do if person A wins versus person B.
You're not betting on that.
We're not. Yeah. And it's just not the way that we manage these funds for medium to long-term investors. The best thing we can do is have a fantastic team of underlying managers, so that's a check, and then use the research to lean in or out of asset classes, geographies, styles, or sectors, right? And make positioning changes when some of those four pillars suggest that we should, right? So let's take down that U.S. equity overweight when sentiment is getting a little frothy, perhaps, right? Let's reel in that Canadian dollar underweight because, again, sentiment and positioning around the Canadian dollar is looking way too negative.
How is EM looking to you right now?
Yeah, so EM, again, the positions that we have in our funds will reflect the conviction that we have in that asset class.
Yeah.
Right now, emerging markets are a slight overweight. I mean, just over 1%.
Okay.
And that reflects, I would say, our conviction in emerging markets, right? So, emerging markets, sometimes when I'm on the road, I'm almost afraid at the end of the night that someone's going to ask me an emerging markets question.
Sorry about that. It's right at the end of the discussion.
Not at all. No, not at all. I mean, emerging markets have been the region or the asset class that's been about to outperform for years,
I
right?
know.
And
you've just been early. We have all,
right?
It's sort of that you're just early story.
And again, the argument for emerging markets has been from a valuation perspective and from a cyclical lift perspective. They're attractive from a valuation perspective, and from a cyclical perspective, the worst is likely behind us in terms of, say, China.
Right.
The problem is we've been at the worst for a little while, right? So it's been kind of a flat V cyclically for some time. The more interesting story, I would say, around emerging markets, and one of the reasons we'll almost always have our toe dipped into emerging markets, is the secular horizon, right? So better demographics, like younger populations. And if you want to talk about productivity, the potential for productivity leapfrogging
right.
in the emerging market is really tremendous, right? So we've talked about this in the past, right? So no formal banking sector, you don't build brick and mortar and then fintech.
Just get it on the phone.
Right, so you could have leapfrog to fintech. And when you combine that with younger populations and better demographics, it sets up the case for a really strong secular growth profile. The problem is right now, we just need to connect the cyclical with the secular, which in the last few years has been tricky. What's
sort of a final thought you'd like to leave everyone with today, Ilan?
Yeah, so I mean, I would bring it back to the funds, right?
Yep.
So in the middle of May, we introduced some really important enhancements, which you've talked to my colleagues about. We introduced alternatives, 3 liquid alternatives into our funds. The way to think about the funds that we manage is I think about them as a simple solution to a complex problem, right? An elegant solution to a complex problem. I mean, in every one of these conversations we cover a huge breadth of topics, right? And these funds take into account all of that thinking and research, and they combine them with really strong strategic allocation and really great underlying managers, right? Which is why we've seen the long-term performance, right? The 10-year performance is 5-star Morningstar rated, very strong long-term performance. And again, we want to keep that up.
Fantastic to have a chance to speak with you right after the Fed made its decision and looking out to next month. Ilan Kolet, thanks for joining us.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.